If you had as much money as you could possibly dream of because you can print it, what would you want to do? Well, you'd want no one to realize the power that you got from them, accepting you printing dollars. And you would use as many back channels as possible to suppress the one thing that is an alternative to the system you're pushing, which is gold as sound money. And it's like, okay, well, how is that different in Bitcoin? And what he points out is that the shadow market for gold, there's all this paper gold that exists, and I'll touch on this in extra details in a second. And it's been possible to suppress the price of gold using fiat currency mechanisms. But with Bitcoin, because of its ability to rip on the short term, on the upside and the downside, it's like a hedgehog. It's really difficult to attack from the top. And anyone that tries to attack Bitcoin in a serious way from a price suppression perspective could get completely wiped out, as this thing does. It can double overnight if it wanted to. Now, yes, there's more institutional capital coming into Bitcoin, and that is naturally dampening the volatility, because a huge pension fund, for example, I want to take a 2% position. They buy 2% of their net assets. That price then moves up by 30%. Well, they rebalance, right? They move it back to 2%. They only want to own 2% from their portfolio perspective. And so that increases the sell side pressure as the price moves up. And that's why I think we're getting a very natural process where the really, really intense volatility is disappearing. But that doesn't change the fact that in Larry's view, Bitcoin is very difficult to mess around with like this. And there's a long history of it. So, and I, of course, I researched for these episodes and I learned quite a bit. But, central banks, they basically, as we already discussed they don't typically trade in the spot market for gold, but they can use all sorts of different relationships, for example, bullion banks, to play around with the price. I touched on the example of the gold pool and how that fell to pieces as they were trying to defend the $35 per ounce Bretton Woods peg. Inflation from the Vietnam War was causing a lot of problems, and essentially it collapsed. But they were openly manipulating the price of gold, right? There's then these things called gold leasing and lending programs, where the central banks, they hold the gold physically, right? But they create artificial supply and paper gold with derivatives products. This creates downward pressure, depleting official holdings permanently. Like, okay, fine. I don't even know what they actually hold behind these derivatives in some ways. The idea, okay, Alan Greenspan in 1999, central banker from the Fed, ready to lease gold in increasing quantities should the price rise. So what the hell? So they're selling paper claims on the gold they have that then can be used to flood the market with supply. Well, inevitably, with there's more supply, the price comes down. They then have coordinated sales and agreements. So, for example, a central bank gold agreement, 8 major European central banks, this was from 1999 to 2014, capped their annual sales at 400 to 500 tons to avoid market crashes while gradually offloading their reserves. So the announced sales created preemptive downward pressure. Okay, it's like a kind of stealth sale in a weird way. Like, what the hell's going on here? The UK in 1999 sold 395 tons of gold, which dropped the price 20% in weeks. Okay, interesting. There's then the derivatives and futures manipulation that goes on. Okay, so I mentioned already bullion banks, e.g. JP Morgan, HSBC, shorting massive paper gold contracts. They call them naked shorts. It's where you're selling without physical backing. What? How can this make sense? Well, it makes sense because the central bank can print whatever they want. The Federal Reserve is in cahoots with the US government. They're the same as, said for the Bank of England and the British government. They use their commercial bank buddies that go out and they use these derivative products to suppress the price on the behest of the money printer. It's classic Cantillon effect behavior. You're closer to the money printer, so it incentivizes you to behave within the money printer's interests, right? Because you make money out of this. And it's nefarious, right? It's full on nefarious. I've even heard central banking described as full evil, right? They are purposefully stealing purchasing power from the average person by printing money, and they're suppressing the gold price so that people don't realize how much money has been printed. Now, when you start to piece all these bits of information together, you're like, what is going on out there? Plus, what an absolutely incredible thing Bitcoin and self-custody is. Baked into the Genesis block of Bitcoin is an article. It says the Chancellor on brink of second bailout. A Times article. Very, very clear that the creators of Bitcoin, the creators, it was focused on one thing, and that was the absolutely heinous thing that central banking actually is. And that Genesis block just shows that. Now, how hilarious that we're even in this situation all these years later, 15 years or 16 years since the creation of Bitcoin. And what a surprise, central banks are printing more money. Central banks are trying previously to have suppressed the gold price, but they now need gold. That's the irony, right? All of these different independent nation state central banks are buying gold. As we discussed already, the demand for gold's gone up. Physical sale of gold has increased. People have been accumulating instead of owning government debt. Now, it's also important to point out that the buddies in the commercial banks, the trading desks, JP Morgan got hit with $1 billion worth of fines for one instance of manipulating the gold market. And it's like, oh, tap on the wrist. Sorry, yeah, we're going to fine you for that. So what the hell?